Welcome to today's financial reality, July 7th, 2025, a day that may silently reshape your investments. The headlines are flying fast. New tariff escalations from the US are shaking global confidence. Tech stocks are staggering, oil is bouncing, and crypto is flashing resilience. It's not business as usual. Today, everything you thought was stable is in question. If you want to be ahead of the curve, understand what's really moving the markets. Not just the numbers, but the meaning behind them. You're not here just to watch, you're here to grow, protect, and empower your capital. US stock futures opened in the red as investors reacted sharply to a sudden tariff proposal targeting major Asian allies like Japan and South Korea. These proposed levies, reaching up to 25%, spooked markets even before Wall Street opened. Why? Because they're not just about trade. They're about global alliances, inflation risk, and corporate profits. Companies depending on Asian supply chains are already adjusting outlooks. And when expectations shift, stock prices follow. If you're exposed to multinational tech or manufacturing, you're already in the splash zone. The full market session delivered a blow. S&P 500, Dow Jones, and NASDAQ each sank over 1%. It wasn't panic, it was repricing. Traders pulled out of growth-heavy techs and consumer cyclicals. Big names like Apple, Amazon, and JP Morgan took the brunt of the sell-off. Meanwhile, defensive sectors like utilities and healthcare saw minor gains. This move reflects a deeper anxiety, that macro pressure is mounting fast. For smart investors, this wasn't a surprise. It was an opportunity to reposition. Global markets mirrored the American retreat. Tokyo's Nikkei tumbled, Seoul's Kospi followed, and Hong Kong's Hang Seng ended lower too. The chain reaction was instant. Tariff tension triggered a cascade of selling. But here's the deeper takeaway. The world still dances to Wall Street's rhythm. If the US investor gets spooked, global money flees to safety. The global financial web is tighter than ever, and understanding the pulse of one region can give you insight into them all. Oil markets were unusually jumpy after OPEC Plus announced a planned increase of over 500,000 barrels per day in August. This came as a surprise to some who expected tightening, not expansion. Crude futures fluctuated heavily throughout the day, signaling a market unsure how to react. Energy investors are now stuck between optimism about demand recovery and fears of oversupply. For those in oil and gas equities, this is a time for caution and perhaps boldness. Volatility often precedes profitable inflection points.
The bond market didn't sit still either. Treasury yields surged, with the 10-year note pushing past 4.3%, a level not seen in over a week. Traders are repositioning on fears of rising inflation and increased debt issuance linked to potential trade subsidies. When yields rise, bond prices fall. This is painful for traditional bondholders, but a window for yield hunters. Understanding bond movement isn't just for economists. It's crucial if you want to protect your retirement and income-focused assets. The US dollar firmed up slightly, reversing a recent downtrend. Risk-off sentiment and global tension pushed capital back into the greenback. Currency markets often overreact, but they rarely lie. Today's bounce reflects a desire for liquidity and safety. For dollar-exposed portfolios, this move could buffer recent losses. But don't get comfortable. Currency is volatile. And in today's multipolar world, even safe havens aren't immune from disruption. Bitcoin showed surprising resilience, closing the day near $109,000, a level that stunned some traders expecting a deeper drop. Despite risk aversion in equities, digital gold held firm. This signals that crypto is maturing into a more stable hedge for some investors. The narrative has shifted from speculation to strategic allocation. Whether you're long-term hodling or actively trading, crypto is proving it's no longer just a sideshow. It's part of the main stage. One of today's surprises came from Dogecoin, which rallied over 5% to hit a one-month high. The rally appears linked to renewed attention from Elon Musk, who hinted at integrating Doge into a political payment infrastructure. Whether or not the project materializes, the market reacted with excitement. Meme coins still have influence and danger. If you're in this space, stay nimble. The swings are fast and brutal. The clean energy sector told a divided story. While CleanSpark and a few battery storage firms soared, legacy miners like Riot and Marathon fell behind. Investors are differentiating. Not all energy plays are created equal. Policies around tax credits and ESG compliance are driving selective momentum. If you're in the green transition trade, focus on companies aligned with long-term infrastructure, not just hype. CoreWeave, the AI infrastructure giant, announced a major $9 billion acquisition of a crypto mining firm, signaling a huge bet on blockchain infrastructure. Mergers of this scale are usually rare, but 2025 has proven unpredictable. This move suggests that big money is still flowing into the foundations of Web3, even if headlines scream recession. The smart capital isn't fleeing, it's consolidating.
Micron, AMD, and NVIDIA had a mixed day. Despite the broader downturn, the resilience stood out. These chip makers continue to ride the wave of AI demand. NVIDIA especially is in a league of its own, with analysts debating when, not if, it will hit a $4 trillion market cap. Semiconductors are no longer a cyclical afterthought. They are the backbone of the modern economy, and they deserve a place in any forward-looking portfolio. Residential housing in U.S. Sunbelt cities remains unusually firm. Phoenix, Austin, and Tampa posted surprising price increases, even as mortgage rates hover near 7%. Institutional investors are back, scooping up rental properties as inflation hedges. It's a quiet boom, and one that retail investors often miss. Real estate might not be sexy, but it's proving sticky. For long-term wealth, don't underestimate the power of doors and roofs. Consumer spending showed signs of resilience in Q2, with credit card usage stable and delinquency rates flat. This is despite elevated inflation and rising living costs. Americans, it seems, are still spending carefully. This data suggests the recession everyone feared hasn't materialized. Retail, travel, and service industries may surprise on the upside in upcoming earnings.
The Genius Act, a sweeping stablecoin regulation bill, cleared a key Senate hurdle today. It would require stablecoin issuers to maintain reserves and submit to monthly audits. This bill could bring legitimacy to coins like USDC while putting pressure on unregulated alternatives. For crypto investors, this is more than policy, it's a signal. Regulation is coming, and those who prepare now will benefit later. The DeFi world remained calm, with total value locked ticking up modestly. Major players are consolidating positions, possibly anticipating institutional inflows. Protocols offering real yield and governance rights are getting attention. The noise is fading, but the foundation is solidifying. In a year of AI and macro shocks, DeFi's steadiness might be its strength. Treasury Secretary Bessent hinted at changing the government's debt strategy, suggesting a pivot toward shorter-term T-bills to manage budget volatility. This subtle shift could reshape duration risk across the yield curve. If you're managing fixed income exposure, it's time to rethink laddering strategies. What's happening in Washington affects everything from savings accounts to pension funds. Tesla dropped 7% in a single day, rattled by new tariff exposure and Musk's controversial political activity. Investors hate uncertainty, and this week delivered plenty. Still, Tesla remains a cornerstone of many portfolios, and its volatility is both a risk and a reward. Don't just follow headlines, follow the fundamentals. Tesla's path is never smooth, but often profitable for the patient. Market strategist Julian Emanuel warned that equity valuations are stretched, with forward PE ratios reaching levels unseen since 2021. He anticipates a 15% spike in volatility if macro pressures persist. That means now is the time for risk control. Stop losses, diversification, and tactical asset rotation aren't just smart, they're essential. The next wave will reward the prepared, not the passive. And finally, here's your power summary. Global trade is shifting, crypto is strengthening, energy is rebalancing, and AI is still king. The next 72 hours will be crucial. Fed minutes are due, inflation data is coming, and the tariff deadline approaches. This is not the week to check out, it's the time to lean in. Hit like, subscribe, and drop a comment. Where are you investing this week?